Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, December the 18th, and before we get into what markets did last week, I just wanted to take a brief moment to wish everyone a happy Hanukkah and a Merry Christmas next week and happy holidays through the remainder of the year. I've really enjoyed our updates throughout this year and wish you all and your families a wonderful holiday season. But as we go into the market update, last week was a down week for the S&P 500, which was only down 63 basis points or 0.63%. The mid-cap index, however, was up 93 basis points on the week or 0.93%, and the small caps carried the mantle for the week up 2.10%. And we're going to discuss why we saw the outperformance in small and mid, as well as the underperformance of the 500 in just a little bit. But as we moved into this week, investors were really looking forward to all of the economic data that we were going to get. And one of the key measures of economic data that we got this morning was the measurement of inflation for the month of November. And the expectations were for inflation to be up 3.1% on the month of November for headline CPI. And it came in at 2.7%, so under expectations. And so you're seeing a weaker jobs market with some recovery in November. You're seeing inflation come down now, still above that 2% Fed target, but you're seeing that come down, and so that has allowed for there to be a little bit of a rally today, especially in some of these more growthy names that have been selling off recently. And wanted to just kind of give way of why that has been the case for some of these growth names to sell off. So anyway, when you enter into a bull market, you're always going to get to points in that stretch of the market where valuations become very stretched. So as we've entered in the last couple of weeks, the big discussion has been around valuations, especially on the market as a whole, especially on a lot of these AI and these growth-related names. Have valuations become overstretched, or have we reached a point where we just need a point of digestion? We've had so much growth where we need just a point for the stocks to catch up to the growth that's been priced into them already. And so when that happens, you see a rotation out of these names into other sectors, as well as with the falling of interest rates. You're going to see money leave some of these names and move into smaller names that have underperformed the market over the last couple of years as a whole. So I wanted to kind of break some things down for you and explain what we kind of see may be the case as we head into 2026, as we expect maybe there to be continued bumpiness in these growth names as we try to digest these valuations where we stand currently. And so if you look at the market and the S&P 500, if you look at the growth versus the value sector over the last 3 years, on an annualized basis, growth is up 28%, value's up 13%. If you look at the last 1 year, growth is up 14%, values up 7%. Now year to date they're about equal, but the significant underperformance over the last 3 years, giving up 15% overall, is why you're going to see some potential rotation, as well as into those value names. And another reason why you may see some rotation into the value names is as interest rates come down both on the Fed funds, and if it does come down on the longer end bonds, you'll start to see money move into those dividend paying stocks whose dividend yield is going to outpace the yield that you're going to get in bonds. And then you'll see some potential inflow into those type of safe haven names next year as those rates come down. And again, why you'll see inflows into small and mid caps as rates come down is, again, going back to something you may have heard me talk about, is that those borrowing costs come down and the earnings increase with all things remaining the same for these small and mid cap companies as rates come down. The cool inflation versus expectations today gives cover for the Fed to maybe cut maybe a little bit more. But as we move into 2026, just wanted to kind of set the stage as there may not be a smooth sailing. I mean, this year was a great year, and we have so much to be thankful for. But if you remember all the way back to April, you know, that was not always looking so bright on the returns. But that's just the reminder to stay patient and stay steady in the markets. And we're thankful for 3 great years of returns in the equity markets. And what that tells us for historical precedents moving forward is that it may be not as great of a return over the next year, just based on how well we've done over the last 3. And again, that just goes back to that point that I made earlier about the whole market just needing to digest where we are from a valuation standpoint. So if you have questions about how to position yourself as we move into 2026, we'd love the opportunity to speak to you. You can reach us at 904-346-3460. As always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful holiday and a happy new year. I'll talk to you guys in 2026. Thank you so much.